Today's topic, really statistical validation. Throwing a little multi-time frame trading. I think that's essential for us, that we understand that markets do different things on different time frames, and as traders, we really need to make that adjustment too. You have a choice. You know, you can be a short-term trader, intermediate-term trader, longer-term trader, and that's all going to involve different time frames that you'll be taking signals on. No doubt, trading is a risky endeavor and not suitable for all investors. My name is Jay Norris. I'm a 20-year trading floor veteran. Published a couple of books by McGraw-Hill, and I also teach trading at Trading University, where we teach in live markets 4 days a week, for an hour every day. It doesn't take up too much of my time. It's only an hour. And I can tell you it's made me a whole lot better trader for it, that's for sure. I've written, here's the books I've written by McGraw-Hill. Good books. Each book provides a trading plan in there, so you can, you can take a look at that trading plan and you can go out and you can test that plan. I think transparency is important for all of us, for sure. So how can we improve your trade selection? That's why you guys came here, right? Unless you're just kind of bored and you have nothing else to do, you're happy with where you're at as a trader, you just want to come and see what I have to say. Thank you for that. But my guess is that most of us, we want to pick something up here that's going to make us better traders, right? So what can we provide? How can we help to secure your success as a trader? To me, it's simple. We're going to show you tactics. We have to show you tactics that were designed to take advantage of the scalable nature of markets. When I say scalable, I mean, yeah, they do different things at different time frames, but, they all feed together. It all connects together there. And what happens on the lower time frames can influence what happens on the higher time frames, just as what happens on the higher time frames will be replicated on the lower time frame. It's scalable. It's scalable parts. Okay, you're going to see the same patterns. Literally, you will see the same ratios of the retracements of the extensions that you've seen 50 years ago, 40 years ago, 20 years ago, that you will see on a tick chart, that you'll see on a 15-minute chart, regardless of the news flow out there. Markets haven't changed. They're scalable. I think we can count on that. And what's beautiful about that is it sets itself up for us to help capture the statistical data of the marketplace. The reason I could say that with confidence, that the ratios of the extensions and the retracements has not changed in my lifetime, and not in 100 years, and probably won't. Well, pretty common, pretty certain won't change. The reason I could say that is because I know the statistics behind this, okay? I study it, so I know that if there's a change in the marketplace, it's only at people's perception of the cause of price movement. It's definitely not in the effect of price movement. That hasn't changed. I read somewhere that human behavior couldn't, it would take tens of thousands of years for human behavior to change significantly. Well, barring you don't get an ice age or something, then of course we'll all be wearing winter coats, but we're still going to think the same, right? This is a very important point right here. The difference between a speculator and a trader. Speculator, someone who makes an investment or places a trade based on a premise, thesis, or opinion. Opinion is a dirty word in this business, okay? Really it is. A trader, someone who bases a trade based on statistical validation, okay? Now, you can be right if your thesis is right or your opinion is right. You can make a lot of money, but, you better be able to change as the world turns, right? So it's much easier in the long run to base your trades based on statistical validation than you trying to figure out the future. I finally figured out that there's no way I'm going to be able to guess the future, okay? I'm not a fortune teller. My crystal ball doesn't work as good as it used to. You can't, nobody can tell the future, right? So in the long run, you're going to be infinitely better basing a trade on statistical validation. I mean, today, it was a great example in the euro. There was a potential double top. It was a counter-trend setup, and I said, statistically, I'd rather wait for it to get to that 625, or I'd rather wait for it to get to the next resistance level than go for the double top. Sure enough, it blasted right. It got to the next resistance, blasted right on through it. There was nothing to do. So stats are going to keep you out of trouble. Now, a trader is an educated speculator. Nothing wrong with being a speculator. You want to be an educated speculator who understands her probability of success or your probability of success. Okay. So section 1, we're going to deal with market-generated information, i.e. fact-based events. That's all I deal in, fact-based events. Number 2, multi-time frame patterns. That's what I mean when I say environment. Actually, when I say, well, this morning the euro dollar, believe it or not, it was in a short-term counter-trending environment, but long-term trending environment. Guess what? The long-term won out. No surprise there. So environment it's imperative. You have to know what environment you're in so that you know which way to trade, right? And we break it down very basic, very math. I mean, you could use a calculator and a pencil. And thirdly, we're going to cover statistical validation. You have to be able to validate what you're doing, right? I mean, you can't just bet on, hey, I think this is going to happen. I think interest rates are going to go lower, or I think that the euro is going to fall out of bed. So, statistical stats here, the number 3, that's just a no-brainer for a professional. You have to have what you do. Your premise not only has to be, thoroughly back-tested and checked, but you have to have the stats. You have to have a pretty good idea what your winning percentage is, etc. What makes a great trader? Jack Schwager would know. He interviewed many traders in his book, Market Wizards. He said great traders are extremely flexible. They can very easily change opinion and go from bullish to bearish or bearish to bullish, right? They don't become wedded to a position. They change it as they see fit. Now, I think he kind of misworded this because I don't think professionals have much of an opinion themselves, although they may have one short term, but it's not the opinion that you have to change. You have to heed what the market's telling you. You don't even have to be good enough to have an opinion. If you have a simple tool that tells you the patterns in the market, and when that tool, obviously has to be a dynamic tool because it has to measure the market as it moves through time. Once that tool does measure change and tells you something has changed, then out the window goes the opinion. And your tool is your new best friend. So I think Schwager got it a little bit off. I don't think professionals have much of an opinion. I think they're smart enough to have the good tools to tell them when the market is shifting, and they heed that shift. In other words, they change their position as they see fit. Well, they change their position realistically as the market sees fit. And that's the secret to it. There is no secret, right? So there is no secret to it. It's just do what the market wants you to do. Raina is having problems with sound. Can everyone else hear me? Hopefully I didn't step on my microphone or something. Everyone can hear me okay? So the secret, thank you, Raymond. So the secret here is see when a market is shifting from a bullish environment to a bearish environment and vice versa, okay? And really, all it comes down is having the proper tool for that. Literally, the greatest swordsman in Japan in the 1800s, his pay went way down the day someone showed up with a rifle, right? Because the right tool and training, in other words, education. Education is going to be everything. If someone knows how to shoot a rifle from 300 yards, that poor samurai, he doesn't have much of a choice. He better go out and learn how to shoot a rifle too, right? So the right tool is everything. And also I think that what makes a great trader is they are aware of what's happening right now, okay? You can't get caught looking at what happened yesterday trying to figure out what's going to happen tomorrow. You have to see what's happening right now. Great example in the euro today, when I see this volume come in on the opening of the U.S. stock market, here's where the U.S. stock market opened right here, 8:30. I know, first of all, I know not to do anything until that level gets out of the way. Here, I'll try to highlight this candle for you. I'm not going to do anything until that U.S. stock market opens up anyway, because that's when the winds start blowing, right? The winds start blowing through the chimes. You have to see how the markets are going to react to that, because we don't know I don't know what the future is going to hold. Who knows? So here it happens to be where the U.S. stock market opened. This is the euro. This is the euro chart. So I'll go all the way down to a 3-minute chart for you, and there you go. Here's the volume coming in on the U.S. stock market open right here. Look at that. From the minute that market opened, here, let me see if I can shrink that box. The minute this U.S. stock market opened, that market started jumping. So if I know that's a tendency in the market, I know statistically you're going to get, the market's going to start moving then, I'm not going to do anything because I'm not going to guess which way it's going to go. But when I see that volume coming in there, boom, 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 then guess what? I'm looking to buy a dip. I'm no longer looking to sell a rally in the counter trend move. I want to buy a dip in with that trend move. Okay, so that's a great example of what's happening in the market right now. Okay, what happened Friday? That's not going to help me. I don't know what's going to happen to tomorrow. I don't have a crystal ball anymore, but I want to know what's happening right now. If I heed what's happening right now, that's a big help to me as a trader. So section 1, we're going to cover market-generated information. Another word for market-generated is fact-based. This is one of the first things that we teach you in our advanced courses, and it's how to build one of these. Okay, that ratio. Stick with me now. This is a very important lesson, and once we get through it, we're going to show you how it applies in the markets right now, too. Now, this is a factual indicator that tells us the current direction of the tradable patterns in a market, okay? Very simple, based on math, right? At that time, in the yen here back in November, this is how the tradable patterns were aligned, okay? And I'll show you exactly how we calculate that. Well, not exactly how we calculate it, but I'll give you an example of how you can calculate your own just using a basic GAN line. I'm not going to give away the proprietary level that we use. Obviously, my students wouldn't be too happy about that if I'm giving away the secrets, right, in webinars for free, right? Now, what's so unique about this indicator is it's not based on individual candles or bars. It's based on the pattern itself, okay? Here's how you use it. Very simply, take any 3 successive patterns, such as your 5 through 25, or maybe you're going to trade the 10 through 50. Okay, you take any 3 successive patterns in there, and you're going to trade in the direction of the majority of those patterns. Okay, so you're going to trade within the majority of the patterns. So if you're trading the 5 through, let me back it down. If you're trading this 5 through, there you go. If you're trading the 5 through 25. 2 out of 3 of them up, therefore you're looking to buy, right? Now, if you're trading the 10 through 50, 2 out of 3 are up, therefore you're looking to buy. So you're always looking to trade within the majority of patterns. Now, when I say trade, this is what I mean. I'm going to buy dips or sell rallies, okay? So if the majority of patterns are up in the euro, I'm looking to buy dips, right? And here's our ratio today. If I'm trading the 5 through 25, 2 out of 3 are up, right? So if I'm trading the 5 through 25, the majority of patterns are up. What am I doing? I'm looking to buy dips, okay? So when the market did this 625 is a GAN level the market respects. There it is right there. Boom. When the market did that 625 retracement, or what we call 5/8 retracement, when the market it retraced more than 50%, because that's what markets do. They like to go beyond 50% because people like to buy a 50% retracement. And so if they buy the 50% retracement, they generally put their stops a little below there. So 625 is a good level to buy. So today the euro happened to stop right on that 625, right? So that's what we mean when we say buy dips, okay? Whoops, wrong one there. We'll get back on track here. So buy dips or sell rallies in line with the majority of patterns. Write this down. If there's one thing you take away from today's webinar, it's this. This is how professionals that aren't market makers, by the way. Market makers, they're there to take the other side of your trade. Nothing wrong with that. That's what professionals do. We need someone to do that. If you're going to trade direction, though, this needs to be your core principle. Your method needs to be designed this. You need to buy dips or sell rallies in line with the majority patterns. At least when you know what the majority patterns are, you know when to go counter trend too. So as I said, we're gonna trade along with the majority pattern. So at that point right there, your majority patterns were up, weren't they? No matter how you slice it, if you trade 5 through 25 or you trade the 10 through 50, majority patterns are up. Therefore, you're looking to buy a dip, right? So you're looking to go long there, and you have a really good idea where you're going to put your stop. And once you employ the method, and it's the same every time, you're doing the same thing every time, you have what's known as a static method, and you're going to get familiar with the statistics on that method also. You're going to realize that, hey, I have my odds of success are better if I'm trading with the majority of patterns. So this, I can't state this enough. Buy dips or sell rallies in line with the majority of patterns. That's our plan overall, right? So here, I'll show you how we did that. Okay, there's the signal itself. You can see it worked. No surprise that the market went up because the majority of patterns are up, right? A blind chicken could have been making money long the yen back then too, of course, right? It's going up. You're a buyer. But I'm going to show you how we construct this. Those are what are called GAN lines. They're just a 625. It's just a 5/8 retracement basically. So here's how we do this. Here I'll go back. You see that the 10-day pattern was bullish and the 25-day pattern, they were both up. So I'm going to go show you how we do that. We're going to take from the big red candle there. Okay, on that day the big red candle came down. We're going to count back 10 days. Whoops. Here, let me first give you the premise on this. Here's the premise. If the low occurred before the high over any time frame pattern and price is holding above that 625 retracement level of that low to high, then that time frame pattern is bullish, okay? So here we'll demonstrate that. So we're going to start out on the red candle, and we're going to go back 10 days, and we're going to mark that low to high. Then we're going to retrace it down. And as long as you're above that 625, then that 10-day pattern is bullish, right? So as long as you're holding above that 625 retracement, you're not closing below it, you're holding above it, then that 10-day pattern is bullish. Likewise, now I'm going to count 25 days back from that big red candle right there. 25 days back. And I'm going to do the 625. Again, as long as I'm closing above that 625 retracement of the 25-day pattern now, then both those patterns are bullish. So my 10-day pattern is bullish, my 25-day pattern is bullish. Very, very simple. As long as I'm holding that 5/8 level, GAN's 5/8, then those two patterns are bullish. So how do you want to be thinking going forward? I said, okay, both patterns, you see it. Now I'm going to shift forward. We don't have the luxury of the lines there, but how at that point in time, when you see that big, what a lot of traders, they'll call that a key reversal. They'll call that a momentum shift. Regardless of the big shift on that one day, the majority patterns here are still up, right? So if the majority patterns are up, then how do we want to be viewing this, right? Do we want to be a buyer or a seller when we see that big turn right there? Of course, we want to be a buyer. So we don't care if the market has a big key reversal. We don't care how shocking it is to everyone that if you happen to have a stop anywhere down here, you had a stop below that low, you got stopped out. That doesn't matter to us. All we know is the majority of patterns are up. And we want to be buying dips and uptrends. That's our plan, okay? So this is exactly what we mean here when we say it's much easier to follow the path the market has laid out for us when we have no opinion. It's much, much easier to do what the market tells you to do if you don't have an opinion in the way. And I'm not even going to get into the bad habits that opinions lead to, right? We'll just leave it at that. If you want to be a successful trader, you got to lose the opinion. Here's a question. Can you have a bearish opinion and still make money in a bullish market? Sure you can. If you have a trading plan, if you follow your trading plan, if you know that you're human, right, and to err is human, so if you know you're human and that you're going to be making mistakes, and you know to laugh that off and to stick to your trading plan, absolutely, you can be handicapped with an opinion and still make money in a market, okay? You can still make money long the euro, even though you think it's silly that the euro is going up, okay? So yeah, absolutely, you can make money with a bearish opinion in a bullish one. All you got to do is buy dips, right? Now this is a trickier question. Are you willing to see both sides of the market? Most people aren't. It takes years. It takes a long, long time to be able to see both sides of the market. What's going to help you see both sides of the market is your trading plan. Is this guy here? We call this the brains behind the operation, okay? I'm not going to argue no matter if I think U.S. interest rates are going down, but I see that the majority patterns are up in the 10-year note, then interest rates are not going to go down yet, right? As long as the 10-year note is bullish, why would I consider selling it? Same thing with the euro, same thing with the dollar index, same thing with gold now. I'm in the bull camp on gold. Yeah, I'm buying dips in gold. Why? Because the majority patterns are up, okay? Now, there comes a time you do need to know these historic patterns, but they're only significant when you get on top of them, right? So, yeah, I'm aware of the historic pattern, but it's not relevant until price gets to that historic level. So that'll be an interesting thing to watch, too, in some of these markets, because you're coming up on historic support or resistance levels. But back to this slide, it's so important that you see both sides of the market, okay? I can't even tell you. Write this down. See both sides of the market, and then hopefully you already wrote down buy dips in uptrends in line with the majority patterns, sell rallies in downtrends in line with the majority patterns. See both sides of the market, okay? Lose your opinion, not your money, okay? And then when you're able to do that, you're going to put yourself in a position where you can take a look at the statistics honestly, okay? What amazes me is how an individual trading their own money refuses to take a hard look at the statistics of what they're doing. They refuse to acknowledge their own statistics. Why? Probably afraid. They're afraid they put in all that time, that work, and they can't admit that it doesn't work. So when their spouse comes in and goes, "What are you doing? When are you going to give that up? When are you going to start making money? All right, I'll give you another month of that. You better start making money," right? Well, before you can make money, you have to have the statistics on it, okay? And this is where I'm going. Why do so many retail traders have such a low success rate? Well, a lot of them are not as successful as they'd like to be because they rely too much on their own ideas and opinions rather than on market-generated information. We can all pick a hobby and not take it that seriously and have fun with it. It's there for enjoyment, okay? Trading is not a hobby, okay? Losing money is a bad hobby. It's a bad idea, okay? If you want a hobby, get a garden. I love a garden. I'm looking forward. We're increasing the size of our garden this year. Looking forward to that, okay? That's a hobby, okay? Trading is a business. They will take your money, okay? So you have to take it seriously. It's not about your own idea. You don't need ownership on your little trading method, okay? You need to make money at it, right? No offense, but people lose money because they don't take it seriously enough. They rely on their opinion rather than on market-generated information, okay? Market-generated information is where you're going to be, where you need to be. It really stands to reason that the more experienced and the better educated a trader is, the more likely it is that she'll succeed, that he or she will succeed, right? Yeah, well, Ray, of course you're afraid because you don't know the statistics. You don't know your own statistics. I mean, if you can go back over time and you know your winning percentage and that you're, for every dollar you risk, you're making $1.40 or $1.50, and that, over time, you have a 70+% winning percentage or whatever it is, then you can see statistically over time you're going to do what you need to do. And you do that in a demo account for a couple of months consistently, and you see that's the magic of it. When you see your live results, and I don't care if it's a demo trade or a micro trade or standards, it doesn't matter. It doesn't matter the size of the account. If you see that you can replicate the statistics, first your statistics bear out in your tests, then they bear out in your live testing, it's a magic moment for people, okay? And this is when you get to where you have harmony. Right now, if you're not successful, it's unlikely you have harmony between your thoughts and actions. It's like you're like that mythical character. If you have an opinion in the market, you're like that mythical character, that mythical Greek titan who they chained him to a rock, and every day the bird would come and eat his heart out, and then overnight his heart would grow back and he'd be healthy, and then the day would start and the bird would come and start eating his vitals again. Man, it's the same thing as having an opinion in the market. Because sometimes it goes your way, you feel great, but, the days it doesn't. Anyway, but you have to have harmony you have to have a trading plan. Your thoughts and actions have to be aligned with your trading plan. Then you have a trading foundation. That's what Bill means. And it's all going to start with market-generated information, okay? You're going to base your trade selection on the what's going on in the market right now, not on what you think should be going on in the market right now. Okay, so what is market-generated information? Information the market provides on a closing basis. Information on a closing basis cannot change, therefore it's fact-based information. Okay, when a market when the euro closes above 138, when you get 2 4-hour closes above 138, that's a factual event, okay? That's market-generated information. Hey, the euro closed above 138 twice on a 4-hour chart. That's valuable information to me, okay? As opposed to, the market got to 138 and then you had a stochastic cross. That means nothing to me, okay? Now, maybe if you said the market had a stochastic cross on a closing basis on the daily chart, maybe that's worthwhile information to me, okay? But there's fact-based information, and then there's nonsense from these technical indicators, okay? And here's a little quiz for you to keep you awake. Which indications are fact-based? That is, they occurred on a closing basis. The stochastic cross, is that fact-based? The daily high and low at 8:30 a.m.? Keep in mind, it's only 8:30 a.m. Whatever the high and low is, that may only be temporary, right? So that's not a fact-based. Buy stops being hit just above resistance. No, that's not fact-based. Now, what if we said the market closed twice above resistance? Yes, that's fact-based. That's what I want to know. Me, I expect the first time up that they're going to knock out the stops above the 618 or the 625. I fully expect them to knock those stops out. But that's not a fact-based occurrence. That won't stop me from getting short at that level. I'll let them knock the stops out, then get short at that level, right? Now, 2 closes below support on a 15-minute chart. Yeah, that's fact-based. The high and low over the last 3 weeks measured from yesterday's close. Yeah, that's fact-based, okay? So there's a big difference here. So stochastic cross, no, it's not fact-based unless you say the stochastic cross down on the close of the daily candle. Then maybe that's significant. Daily high and low, no, that's not. Buy stops being hit above resistance, no, that's not. It's not factual. It's not a fact-based occurrence. It didn't happen on a closing basis. And then the last two, of course, did happen on a closing basis. So that's information that's worthwhile. That's information we can rely on. So why is fact-based information so important in trading? It's much more stable. There's no more repaints. If you guys have ever if you've ever tried to backtest and it looks great in the backtest, but then you go forward test, it doesn't work. You're like, why? I don't understand why it doesn't work. You don't understand repaints. A moving average cross can cross and uncross many times over the life of a 60-minute candle. So you can't just say my trigger is a moving average cross. It has to be a moving average cross on a closing basis, right? And bottom line, market-generated information, fact-based information, it teaches us patience. If the trigger says we can't go long until we have a trend line break and a moving average cross on a closing basis, or we can't go long until the market closes above the high of the lowest closing candle, has to close above that high. That's a fact-based occurrence. It's going to teach us patience. And most important, a fact-based occurrence can be statistically validated. You cannot statistically validate a moving average cross unless you say it's a moving average cross on a closing basis on the 15-minute chart. Okay? You cannot validate a stochastic cross or a MACD cross, period. I don't even care if you say on a closing basis, because I have the best, pretty good software, that money can buy, right? And I'll see the angle of a MACD or the angle of a stochastic change based on what happened like 3 candles later. So to me, technical indicators, they're not fact-based, period. The moving average cross is somewhat helpful. The angle of a MACD is somewhat helpful, but you can't rely on them. You can't rely on them to replicate themselves as you can with just the market closing above the high of the lowest closing candle, or a market closing above a specific level, retracement level. So you can't. To me, technical indicators don't lend themselves to statistical validation, bottom line. So these are 3 very, very powerful reasons why you need to get away from monkeying around with indicators and get on working on price, which is fact-based, which you can validate statistically. So, it comes back to how can we improve your trade selection? Show you tactics that were designed to be able to capture statistical data. Section 2, multi-time frame patterns. That's what market environment is all about. And, I apologize that our webinars go on for so long, because I know that it's tough. You guys, your minds are wandering right now. You're looking out the window, or you're looking at your own charts. And that's not your fault. That's how the mind works, So it's tough to fill an hour and keep your attention. No matter how good it is, it's tough to hold your attention. So I would just ask you, try to hang on, try to focus on what we're teaching right now. But I don't blame you if you can't, because, again, it's an hour is an awful long time to sit here for us to all be patient and keep our ears open, right? So know what is happening in the market right now. Very, very important, okay? Well, what if we could give you a simple tool to tell you whether to be a buyer or seller, and that it's based on current trends in the market, okay? And there's no subscription, there's no complicated software or hardware. You update it yourself. You see how effective it is day in, day out. You can see it working in nearly all the markets before you risk your hard-earned money on trading education, let alone risk your money in the markets trying to trade, right? So what if you had that simple tool? Well, that's what we have here. That's what we call a risk tolerance threshold ratio. It breaks a market down into its current patterns in time and designates those patterns as being up or down. Basically, it gives us the direction. So to me, if you're not happy with your current trading performance, you need to have a method or tool in place that measures tradable patterns based on market-generated information only, okay? It will make learning to analyze and trade markets so much more enjoyable. If you think about it, our overall goal should be nothing short of getting so good at trading that we love to trade. I wasn't happy today because the market didn't give me a buy or sell signal today. It literally didn't. I mean, I wasn't awake here, and then it wouldn't give me the buy signal when I wanted it, because then it had numbers out, and then it never gave me a sell signal in here. It didn't give me a buy signal down here. It didn't give me a sell signal there. So I had nothing to do, and then it blasted off, and there's nothing for me to do today. I love to trade, so today was not that fun of a day because there was nothing to do for me. But literally, our goal really should be nothing short of loving to trade. You got to get to where you love it. And that's the one thing that separates the professionals, too. And Jack Schwager was saying what makes a great trader. A great trader loves what they do. They have such confidence in their tools that they know over time they're going to come out ahead because they love it. They have confidence in it. So again, the tactic behind this is take any three patterns and buy dips or sell rallies in the direction of those patterns, okay? The actual price levels we focus on to determine whether it's a buy pattern or a sell pattern is straight out of Dow theory. It's a tenet in Dow theory, so you got a little bit of history behind you. Now, this is a great example. Okay, you want to be a buyer then? Focus on, well, you don't want to be anything. You just want to make money, right? So in this particular market, if you're going to focus on the very short term, then you're buying dip, okay? If you're going to focus on a little bit longer term, then you're selling rallies, okay? I'd rather look at this than a chart. Seriously, I'd much rather look at this than a chart. And here's the power of this. Here is that ratio where if you happen to have 3, 5, and 10 are telling you, these guys are telling you to buy dips, and these guys are telling you to sell rallies. Not bad, right? You're buying it here, selling it there. Buying it here, buying it there, selling it there, buying it there. I'd rather trade both sides of the market because I'm going to trade more often. And if you ever took a market and imagine it was a string and tried to pull it and straighten it all out, well, that string would be awful long, right? Look at all the market movement in there. If you pull a market apart and string it out, so there's a tremendous amount of space in here to make money. I mean, you're buying it, selling it, buying it, selling it, buying it. I'd rather do that. Just literally, if you buy it here and sell it up there, you're going to make more buying it, selling it, buying it. So, but it depends on the environment. You have to be in a counter-trending environment to do that. So, simple tool like that's going to take all the guesswork out of it. And here's that chart again and again. You go back in time, and at that point, that's how the market read. That was the environment you're in. So when everyone else is worried about this big anomaly here, when the market turned around on heavy volume or whatever, this big red candle here, you didn't know what to do. You're like, oh, it's independent. I don't know, buy it or sell it. I don't know. Well, you home in on these patterns here, and you know pretty much exactly what to do. And I just went back historically. I was curious, and I looked at how the pattern was set up for some big turns in the market. And here in April 2012, you had a big sell-off in the euro. And no surprise, you had the majority bend down. Now, you also had a pattern of lower highs here, right? But higher highs, too. So you would have been in a pennant. But the ratio was telling you that with the majority of patterns down like that, you were better off, obviously, selling rallies. And this is a fun one. We went back to the October of 87, the crash of 87. And I didn't know this, and I think I told you this last time. The 50-day pattern here had shifted bearish. If you went back and you counted 50 days back from here, actually went back 50 days, this 50-day pattern shifted bearish here. So all you were doing is selling a rally after a 50-day pattern shift. So that was a good rally to sell, right? So all we're showing you is that RTT ratio, what we call it, it's a trading tactic that identifies market environment, which again can be statistically validated. Because if something's not statistically validated, you're kind of wasting your time, aren't you? Yeah, you need to know it's going to work ahead of time. Like Ray said, he knows plenty of guys that they're afraid to press the button because they haven't had success. Well, the way to get past that fear is get in a demo account or a micro mini account, whatever. And well, first of all, you have to have a trading plan. Then replicate that trading plan in a demo account or a micro mini account. Then when it comes to trade, sure, you'll still be jittery, but you know what? You're not going to be as jittery. A good friend of mine, good client of mine, he's an eye surgeon. He loves to tell the story. He tells us all the story that his first couple of years as an eye surgeon, he was nervous. The first couple of times, well, he said that probably the first 100 times he had to put a diamond blade into somebody's eye and make an incision in their eye as an eye surgeon. He was scared about that because he knew one wrong thing and he could blind somebody, right? Well, that's why he had to go to medical school for 7 years and train extensively. But literally his first several years at his job as an eye surgeon were very stressful, very frightening for him. Sound familiar? As traders, isn't it frightening for your first couple of months getting used to pulling the trigger? So it's the same thing with anything, right? You're going to have fear in it, and the way to get past that fear is be highly trained and be very well educated, and that's why doctors are so educated. Well, hopefully the majority of them, right? This is critical here. A static trading plan that gives us the direction to trade in and the levels to enter and exit trades at, combined with dynamic tactics to provide triggers and management decisions. Today was we made here on the 3-minute chart. This is statically we are actually looking to go short at this level right in here, that previous high. So we are considering going short there, but we have to wait for the dynamic signal. We had 8:15 number, so we couldn't get short in here. Then we had to let the stock market open up, and look, it happened. The U.S. stock market opened up, boom, boom, boom. So the minute the stock market opened up, they took out that resistance, so there was no trade for it. We were waiting patiently. Our static plan said that this area on the chart right here, 39.10, was a good area to look for a sell setup. But what happened? A dynamic occurrence happened. You had a number, and then you had the U.S. stock market open up, so we didn't do anything. There was no trigger. We generally wait for that U.S. stock market to open up and blow through. We want to see that wind blow through the chime. You don't want to trade ahead of that noise. So we let the market open up first. So that was an excellent example of having combining a static trading plan with dynamic tactics. Dynamic is obviously it's ongoing. You're constantly measuring change. The one thing you can count on in the markets is change, right? So if you do that, you're going to get off that merry-go-round of perpetual preliminary education, okay? Everyone's willing to even give you preliminary education, okay? Open an account here, we'll give you this. It's great. You need to have that, but it's like being stuck in the 3rd grade. It's like being stuck in secondary school year after year after year, okay? The way to get off of that is learn tactics that lend themselves to statistical validation. Then you can see if you're wasting your time or not, because if a method statistically validated, you're going to find success. It's going to be easy for you to see that it works, and you're going to be a lot more confident in your trading. So it comes down to statistical validation. Now, hopefully, this is making sense to you. All we need for the market is for it to provide us signals so we can take the appropriate action. The market dictates what we do, okay? So many people, they're caught up in the cause of market movement that they're blind to the effect of market movement. Well, I could tell you their partner's not blind to it, because they, at the end of the year when they're doing their taxes, they're seeing that their partner didn't come out as ahead as they would have liked to, okay? So the effect of trading for many people is that they lose money. They're stuck trying to figure out the cause of it because they think that's going to help them. If they could just figure out what the Fed is going to do next, they can make money. No, you have to focus on the effect of market movement. And the effect of market movement is the effect is perfect. The effect is if you went along here and you had your stop too close, you got knocked out, okay? You have to understand that dynamic, that when you start to see a higher high, a higher low here, higher low there, higher low. Once you start to see that pattern of higher lows, brother, you better get on the long side of that, right? So that's the effect. You need to focus on the effect of market behavior, not the cause. So rely on the market, okay? Rely on statistical validation. Oh, I got to show you that again. This is my favorite slide. Guess what's the biggest hurdle for people trying to get past to take that step to professional trader status? Your emotions, right? And now the only way past that overdrive reaction, fight or flight, when you're confronted by loss or failure, is the subconscious belief that the method you're employing will, over time, produce desirable results. Okay, you have to turn the fear of failure and loss into a love of being rewarded for following your trading plan. Okay, now before you can feel that love, you got to know that you're going to have desirable results, right? How do you know you're going to get those desirable results? Well, the statistics are going to show you that. You have to have your trading plan at first, and you have to employ that in a demo or a micro account or mini account, and you have to achieve those desirable results on a regular basis. Now, it helps if you have a method that you can see immediately that it's going to work, right? Ray said paying for education. Well, I don't know any other way to trade. It doesn't surprise me that the trader that has the most experience and the one, the education, is the one that the money tends to flow into more, right? So without that steadfast belief that you're going to get those desirable results, you're wasting your time. So for me, the only way to get that, the only way to acquire that belief is statistical validation. You have to capture the statistics of your method to determine if the potential outcome is worth the risk. You need a static trading plan, meaning the trading plan is the same over and over again. But what changes is the market. So we teach you dynamic tactics, but it's a static trading plan overall. So you have to have a sound static plan, and then you have to have sound dynamic tactics that you can validate. Here's our trading plan. That's a static trading plan. It doesn't change. It's the same all the time. You have to have one of these to get one of these, which is a benchmark spreadsheet. So once you get that benchmark spreadsheet, and ideally this is your own demo trading or micro trading or close to it. Once you have one of those, then you're in good shape, okay? I think we're running out of time here. 4 very important steps. Most people don't guess number 1. They don't realize the level is much, much more important than the market, okay? We choose the market and direction to trade on based on the level. Focus on the level. Know what level differentiates between a bull pattern and a bear pattern, okay? If I could tell you that a pattern is bullish or bearish, then I can tell you any pattern. If I know with confidence that a pattern in a market based a time, any slice of time, what that direction is, then I could tell you on all slices of time. So I'm picking. I don't pick the market. It's the levels in that market. Then it's the market and direction. Then it's when to buy and sell, and then how to manage your trades. You need a dynamic method to manage the trades too. And here's the importance of level. Here, you see these they're both 625 levels. I'm taking that low to high, and I'm measuring down to that 625. Okay, that pattern is bullish. Okay, so that short-term pattern is bullish. And I'm going to take that little low to high, and I'm going to track it down, and as long as I close above that little pattern is bullish, right? So I have overlapping bullish patterns. Now the question is, what's my ratio? So if the majority patterns are higher, no kidding, I'm a buyer in here. I want to be a buyer right in here, and I want to focus on that buy side, and I want to keep buying dips in that market because I have 2 overlapping bullish patterns in an environment where the majority patterns are up. So it's so important to focus on the level. Excuse me, I would much rather have this to focus on than the chart, because you look at that chart and immediately your opinion starts going to work. Okay, you're going to bypass the logic side of your brain, and you're going to go right into that area of the brain where you want satisfaction now. You're going to go right into that impulsive area where you want happiness now, right? Instead of delaying the gratification, doing your homework. Whoop, excuse me. So you need to have a method, a static method that's going to tell you which way the market's situated now, so that you can play the odds the statistics on your side. So how do you do that? Buy dips and uptrends in line with majority patterns, sell rallies and downtrends in line with the majority patterns, right? So it's no secret, that's for sure. And there's just an example of that. You're just buying a dip and an uptrend, and the majority patterns are up. What is that? The euro? Yeah, that's the euro. A couple weeks back, it works, right? Buy that 6.2, mark out the 6.25. If you see the market holding and then it starts to reverse, you see a shift of momentum higher, then that's a good time to go long, right? Here's selling rallies in a downtrend. There's the Aussie. You take that high to low and you mark up that 6.25, and as long as you have the majority patterns down at the time, you're looking to get short at that low. And it has nothing to do with what you think is moving price. It has everything to do with you moving along with price. Don't get caught up in the cause of price movement. I know I'm not. Well, I can only speak for myself. I'm not smart enough to figure out what's going to cause market to move which way next. I can't tell the future with any kind of statistical validity. Believe me, I'm not a soothsayer. I don't know what's going to happen tomorrow. Okay, but I do know that by using a static trading plan that employs dynamic tactics to it, that statistically I have a better shot of being successful at trading than just willy-nilly trading off my opinion, right? How to manage the trade, very important. Always base your initial reward as a percentage of risk. Most people, they think they're going to get this 3-to-1 or 4-to-1. They're going to risk $100 to make $400. Professional risk $100 to make $140, $150, and he knows what his slippage and his commission is. Okay, so after fees, commissions, and all that stuff, if you can take out if you're 1.4, you're in great shape. If you're winning more than you're losing, and you're making more than you're losing, then you don't need this 3-1, 4-to-1. You're not going to get that anyway, realistically. You're not going to be able to afford to trade long because, you're not going to get the 3-to-1, 4-to-1 as much as you think. So be aware of that. So those are tips on how we manage. Those are dynamic. That's just dynamic methodology. And here's the static trading plan again. You have to have one of these to get one of these, right? So you have to have a static trading plan to be able to get the statistical results, and then you're in good shape. Obviously, it speaks for itself, benchmarking. This is our whole point, that the benchmark provides assurance that the method is valid and can yield desirable results or not. And this is very telling for me. Well, here, the next one is good. The fact that you're keeping a benchmark spreadsheet or not tells us where you are in your trading journey. If you're not keeping a spreadsheet that validates the performance of your trading method, you're afraid to do that then you have a problem, right? If you're afraid of your own statistics, then trading's a hobby for you, right? So you definitely have to get past that, because you got to get to the point where you have stats, And here, look at this. This is a client of ours sent this in, Laurent in Paris, and his first 4 trades, 3 of them were losers. His first 7 trades, 4 of them were losers, and he kept going, and then look at how it's smoothed out. You have to know statistics so that you know when you're having a drawdown that's normal. So, this is what we do. Here's where we're at. We teach people how to trade. We teach you how to trade so that you can have that statistical knowledge that in the long run, you're successful at trading, but in the short run, you get on the right track, okay? And here's what's unique. It's per month, okay? You only pay per month. You pay $199 your first month. In that first month, you have access to everything, okay? Call me up. We can have one-on-ones. You have access to what everyone else is going on. You have access to everything in our eCampus, our most advanced material. You have access to everything up front. If you don't like it, you're not going to continue to pay. So it's $199 for the first month. If you don't like it, learn everything you can in that first month, and you're not going to continue to pay anymore if it's not for you, right? If you do like it and you get 6 months into the program, it's free lifetime. You're a free member. Pay $199 a month, a little less than $1,200. You have free lifetime membership. You have access to everything too. Okay, 24/7 access to the campus. You get to it's actually it's 4 days a week. We do 2 days a week where we teach, and then 2 days where we demonstrate that's open to the public. And, of course, you have access to the Skype chat group and one-on-one mentoring. For your first 6 months, you can call me up. We can set one-on-one times, and we can get together, and we can show you what we do. So if you want to know more, come and see us on the website. Oh, and here's here's what I wanted to show you. Here's where I want to go with that. There's our book. Here, let me give you a link to this. Much of what we talked about is in this book. A lot of what we talked about is in this book. Here, let me give you the link to the book here. So if you want more detailed information about us, you can go to our website there. And we certainly appreciate getting to talk to you guys. If you want my information, there you go. And I just dropped here. Let me drop the link to the book in there. There you go. There's the link to the book, Mr. CC. Good to see you, Mr. CC. Here, I'll give it to you again. And that's it's on Kindle. Kindle, by the way, is free. I mean, if you can just download the free Kindle app, and there's the book. And a lot about what we talked about is in that book. There you go. Thanks, Ray. Okay, thanks, FX Street. And there's our website, and here's my information right there. Okay, thanks, you guys. We'll catch up with you next time. Oh, thank you.